Hi, grade 12. Today we will be doing accounting paper 1. And this is from the June exam of the Gauteng province. And I will be focusing on question 1, which is the statement of comprehensive income and notes to the balance sheet. So that is what we will be doing. And this is for 65 marks. So question 1.1 says company concepts. And the question here says we have to match column A to column B. They give us the term in column A, and we have to match that with the correct description in column B. So, okay, let's start with our definitions. So, a director is someone who manages the company and makes the big decisions in the company. So, a director is not the owner of a company, it just manages the company. So let's look here by A, B, C, and D if we have a description like that. So look at number C. Number C says an elected member of the board responsible for the running of the business and implementing policy. So I would say that is a director. So 1.1.1 is C. So we fall in C over there. Then let's look at the next definition. The IFRS. So IFRS stands for International Financial Reporting Standards. So these are like accounting rules that accountants must use when they prepare financial statements. Okay, so let's look at A, B, C, D. When I look at number D, it says guidelines for the preparation of financial statements to ensure consistency. So I would say that suits the IFRS. So I'm going to say 1.1.2 is number D. Then, independent auditor. What is an independent auditor? So an independent auditor is someone from outside the business. Remember? Independent. So from outside of the business who comes and checks the company's financial statements to see if it's fair and if it is accurate. So let's look in column B if you find something like that. Look at number A. It says responsible for expressing an opinion of the financial statements of a company. So yes, an external auditor will express an opinion of our financial statements. So I would say 1.1.3 is A. And then let's look at our last concept. The concept is shareholder. So what is a shareholder? A shareholder is someone who buys shares in our company, which means they own the company. So number B here says owners of the company. So I'm going to write B over there. And this is for 4. So if we had to mark this, 1, 2, 3, 4. And there you have 4 out of 4.
Okay, let's go on to our next section. We're doing question 1.2. So 1.2 says the following information relates to John T Limited and our financial year ends the 28th of Feb 2024. So if that is the end of the financial year, we know that the beginning of the financial year is the first of the following month. So after Feb, it's March. So the first of the next month, but in the previous year. Okay, so that is the beginning of the financial year. And 1.2.1 says we have to refer to information C and we have to calculate the missing amounts in the fixed asset note. And this is for 10 marks. Okay, so let's go to information C and use information C to fill in the missing numbers. So to fill in the missing amounts. Okay, here we have information C. So missing amount number 1 falls under land and buildings. Okay, so the missing amount is the cost price at the beginning of the year. So cost price at the beginning of the year is missing. Okay, so I know this cost at the end year is equal to the cost at the beginning. So the cost at the beginning plus additions. So plus additions. Because there's no disposal, There's no disposal. So let's fill in what we have. Our cost at the end is 7,890,720. So that cost at the end is equal to cost at the beginning. So I don't know what that is. I'm going to make it X. I don't know what X is. Plus my additions, which is 1.5 million. So to get cost at the beginning, which is X, I'm going to say cost at the end minus additions. So that will give me cost at the beginning. And then my cost at the beginning is then 6,390, 720. And that's the cost at the beginning. And the only part I'm going to write down now in my answer book is this part over here. So I'm going to write this part. I'm going to go rewrite this inside my answer book. Okay, so there I wrote it down. So just to explain again to you, this is cost at the beginning. So cost at the beginning is then my cost at the end minus my additions. So that's my little formula over there. And that's how I got that. And in the memo, this only gives me 1 mark. So let's look at number 2 and number 3. So number 2 is over here. And then number 3 is over here. Okay, so let's look at number 2. Number 2 refers to disposal at carrying value, and this falls under our vehicles. So let's go read our information. Do we have anything on vehicles? Okay, it says here in bullet number 2. Do you see here by bullet number 2? It says depreciation on vehicles. So depreciation on vehicles is calculated at 20% per annum on the diminishing balance method. Okay, and the total depreciation for the whole financial year was 83,200. Okay, if I look at my table, do you see there is the depreciation for the whole year? So that's recorded. So we are not looking for that. We are looking for disposal at carrying value. So let's read further. It says on the 29th of February, so this is the end of our financial year, a vehicle costing 200,000, so the cost price was that, was sold for cash for 118,000. So that was the selling price. The business made a loss of 10,000 rand on the sale of this asset. So this adjustment here has to do with the sale of an asset. And this disposal at carrying value has to do with the sale of an asset. So we are definitely busy with the right bullet point. So we're going to use this bullet point to work out disposal at carrying value. Okay, so for disposal at carrying value, we can do an asset disposal T account. Here is normally the cost price of the asset that you're selling. Here is the selling price, and that is the accumulated depreciation up until the date of sale. And then we have a selling price. And then if you make a profit, it will go on this side. And if you make a loss, it will go on that side. Now, if we read our adjustment, we see we made a loss. Okay. So that is basically the T account. We have all the information. So now I'm just going to fill it in. So we sold a vehicle and the cost price of the vehicle was 200,000. So here I'm going to write 200,000. And then it says it was sold for 118,000. Okay, so that's the selling price, 118,000. Then it also says we made a loss. So we made a loss of 10,000 rand. So that 10,000 can go in here. So the missing amount is the accumulated depreciation. So remember, we don't balance the asset disposal account. So because the missing amount is here, it means the biggest amount is on the other side. So the biggest amount is on the debit side. So that means this is 200,000 and this is 200,000. Okay, that means we have to work out this missing amount over there. So how do you get that missing amount over there? You say 200,000 minus this gives me that. Okay, so I'm going to do that quickly. So here I'm going to do a side note. I'm going to say 200,000 minus 10,000 minus 118,000 gives me the accumulated depreciation over there, and I get that to be 72,000. So this is 72,000. Okay, so far I have the asset disposal account. That is still not the disposal year at carrying value. So that's not that, eh? Disposal at carrying value has a formula. So this disposal at carrying value over here is always, let me go back to the asset disposal account. That disposal at carrying value is this amount minus that amount. So it's the cost price minus the accumulated depreciation. So if I had to write the disposal at carrying value is the cost price minus the accumulated depreciation that we just worked out, eh? So my disposal at carrying value is actually 128,000. And that's the final answer for that missing amount over here. So, okay, how are we going to write this now in our answer book? So here's all the information. I'm just going to have to rewrite all of this quickly in my answer book. So in my answer book, I first worked out the accumulated depreciation. So I'm just going to write that down. I said 200,000. And then I said minus the loss. And I said minus the selling price. Eh? That's what I did. And the answer I got there was 72,000. That's the accumulated depreciation in the T account. Then for the carrying value, I said, oh, carrying value is cost price minus accumulated depreciation. And therefore, this missing amount over there, that missing amount. So that missing amount is then 128,000. That is disposal at carrying value. Okay, let's go look at this number 3 in our missing information. Okay, number 3 over there is carrying value at the end of the year. Okay, so this is an easy one. Carrying value at the end of the year. So I'm just going to do it in the table. So carrying value at the end of the year, this is for vehicles, is the cost price at the end minus the accumulated depreciation at the end. So here's the cost price at the end. So the cost price at the end is 452,000 and then minus 247,200. So I'm just going to minus those two and I get 204,800. So, okay, let's mark so far. So for the previous question, you got 4 marks. So here you get for the cost price, you get 2 marks for the accumulated depreciation, and then you get 1 mark there. So there's 1 mark, there's 4 marks. This one is also 1 mark. And then we're looking at the last part of this question. So we're still filling in our table. So the fourth missing part is this one over here. So let's highlight quickly. We are now looking for this one over here. Okay, so that is now under equipment. So we have to go read the information and see if we find something for equipment. So let's read the last bullet point. It says, depreciation on equipment is calculated at 15% per annum on the cost price method. The company decided to invest in new equipment. So we see the new equipment here. There's the additions. Okay, that's the new equipment. Since the equipment was very old. Okay, the new equipment was bought on the 1st of November. So the missing part that we're looking for in our table is depreciation. Okay, so we have to work out depreciation. So depreciation on any asset, like for example, in this case, we're doing depreciation on equipment. So depreciation is always broken up into 3 parts. You need to work out depreciation on old equipment, on new equipment, and on sold equipment. But can you see here by disposal at carrying value? Do you see here there's nothing there? So here by disposal is 0. So there's no sold equipment. So that means this one can be taken away there. So let's take that away. So we have to work out depreciation for old, and then we have to work out depreciation for new equipment. And then we're going to add those two together, and that will give me total depreciation for equipment. Okay, so I'm going to start with depreciation on old equipment. So because the equipment is very old, there's something you must check first. If I had to work out the depreciation on the old equipment, old is always the equipment here at the beginning. So I would say I will take the cost price of the old equipment and I will times it by the 15% over there. So 15 over 100. And if I do that, I get my answer to be 118,500. So that would be the depreciation on my old assets. But because the equipment is very old, I'm quickly going to check what's the carrying value of the old equipment. So let's quickly make a note. So this is very important. So I'm going to quickly do a check. I'm going to work out what's the carrying value. Now carrying value is the cost price of the old equipment minus the accumulated depreciation of the old equipment. So the value of the equipment at the beginning of the year is this. So can you see I'm taking this minus that. So minus the AD, accumulated depreciation, and I get the value to be 80,000. So grade 12s, do you see that the value of your old equipment is 80,000, but the depreciation is more than the value of the equipment? So that can never be the case, So depreciation can never be more than the carrying value. So because we can't do that, I'm going to take this 80,000 because that's the value of the equipment. And I'm just going to say minus 1. So I'm going to say minus 1. And this gives me 79,999. That is the depreciation of the old equipment. So old is this amount. So now let's go to new. So new equipment, let's go. So it says we bought new equipment. So new equipment was bought on the 1st of November for 150,000. So new equipment, it's the cost price method. So I say cost price times the percentage. But because it's new, I have to include the months. Okay. So it was bought on the 1st of November. The end of the financial year is 29 Feb. So I have to count from the day I bought it till the end of the financial year. So if I count this, I'll count the whole of November. So it's the whole of November, the whole of November, the whole of December, the whole of January, and the whole of February. So I count 4 months, So it's the whole of November, the whole of December, the whole of Jan, and the whole of Feb. That's 4 months. So when I say times months over there, I can now change this months. I can change it to 4 months, and that's 4 over 12. And this cost price here in front, I can also change. The cost price of the new equipment is 150,000. And I get that to be 7,500. Okay, so if I want total depreciation on equipment, I'm going to say it's this one plus that one. But let's go to our answer book and see how will we write this down. Okay, so I'm back here. So for old equipment, depreciation on old, I'm just going to write 79,999. So how did we get that? We took the carrying value, the 80,000, and we just said minus 1. That's how we got that, And then I'm going to write, but what about the new equipment? How did I work that out? I said cost price times percentage, and then I said times the number of months, and I got 7,500. And then I added these two amounts. So I added those two amounts over there. So if I add those two amounts, I get 87,499. Okay, so this one will have 1 mark. This one will have 2 marks because there was a calculation and then you get another mark there. And that's 4 marks. So then 1 plus 4 is 5. 1 plus 4 is 5. And that's how you would get 10 out of 10 for that question. Let's go to the next part of the question. It says complete the statement of comprehensive income. Now, before I go to the income statement, I quickly want to see, based on all the calculations we did here, what must go to the income statement from note number 3. So let's look at that note number 3 that we just finished. This note over here, the note for fixed assets. Let's look at this note. What must go to the income statement? Do you remember we had a disposal at carrying value over there? That means we made a profit or a loss on the sale of the asset. So in my answer book, do you see this 10,000 there? That was a loss. The business made a loss on the sale of the asset. So that's the first thing that must go to the income statement. Let's go to our income statement. As you can see, this has been recorded. Do you see a loss on the sale of asset? If it wasn't there, you had to write that in. Then another thing from the fixed asset note that must go to the income statement is depreciation. So depreciation. All of this whole line must be added together. That must go to the income statement as depreciation. So they have the depreciation for vehicles, but they don't have the depreciation for equipment. So I'm going to go add the depreciation for equipment in here. It's this, the old and the new, 87,499. So I'm going to go add that as my total depreciation. This is 87,499. And I'm going to total this, and I get 170,699. Okay, I think that's all I had to record from the fixed asset note. I don't see anything else. So I'm going to go to my adjustments now and start my income statement. So here we have all the balances at the end of the year. We know that when you do the income statement, all these accounts, they must go to the income statement, except ordinary shares for dividends. Everything else can go to the income statement. Some are income, some are expenses. So it's been filled in for us. If you can look here on the right hand side, we just have to read our adjustments. So let's go read our adjustments. It starts here by information B, additional information and adjustments. I'm going to make notes first and then record on my answer book. Let's start with adjustment number 1. Adjustment number 1 says a credit note for 14,400 was issued on the 28th of February, the last day of the financial year, for goods returned by a customer. So a customer returned goods to us, and the selling price of the goods, so that is the amount on the credit note, that amount is 14,400. So when I write my adjustments down, I'm going to write when goods are returned. So there are 4 accounts involved when a debtor or a customer returns goods. Goods were sold with a markup of 20% on the cost price. This adjustment touches 4 accounts and no entry has been made. It means we have to touch 4 accounts. So the first account that is affected is sales. Then cost of sales. Then what is being returned? Goods. That means trading stock is also affected. And then, because it's a customer who returned goods, a credit note was issued. Debtors control is also involved, okay? Because now the customer doesn't owe us this amount of money anymore because he's returning goods. So now let's see the effect on these accounts. If goods are returned, it decreases my sales. That's a minus. That means it also decreases my cost of sales. The debtor now owes me less money because he brought the goods back. But my trading stock that I sold, it actually gets more. So trading stock is the only account that gets more. The price by which the account is affected is different. Sales is affected by the selling price. Cost of sales is affected by the cost price. Trading stock is affected by the cost price, and debtors control is affected by the selling price. So because we are busy with the income statement and balance sheet, but when you look at the question, remember you must focus on the whole question. They want the ordinary share capital note. Then they also want the equity and liability section of the balance sheet. So because they only want equity and liability, does debtors control over here? No, it's not involved. So this one, we're not going to show the effect of that in this exams. But the income statement has sales, it has cost of sales, and then we know the income statement will have a trading stock deficit or surplus. So we also have to deal with this over here. Okay, so now, before I go back to my answer book, remember the adjustment. So let's go back to the adjustment. The selling price, the credit note was for 14,400. So the selling price was 14,400. But I need the cost price. I'm going to do it this way. Cost price is equal to selling price divided by 1 comma markup. Mark up. So the cost price is equal to 14,400 divided by 1 comma. Let's go read the percentage. A markup of 20%. So then 1 comma 20. So I get my cost price to be 12,000. So this amount is 14,400. This amount is 12,000 by cost of sales. Trading stock is also 12,000. So now I'm going to go to my different accounts. Trading stock at the moment is not. It is not in my income statement, but it is here by the balances at the end of the year. No entry has been made, eh? So here by trading stock, it says plus 12,000. I'm going to add that on my question paper, eh? For sales and cost of sales, I'm going to minus 14,400 from sales. That's the cost price. And I'm going to minus 12,000 from cost of sales. Yeah. So that was adjustment number 1. Okay, so let's go to adjustment number 2. It says stock on hand as per physical stock. So someone went to count the stock in the store at the end of the year. They found that we have packaging material and trading stock worth this amount in the store. Okay? So let's make a note. For trading stock, I am always going to see what's in the book. So that's the balances, eh? And then I'm going to minus what's on the floor. So let's go. What's in the book is what's in the table. So I'm looking at these amounts, eh? I'm looking at those amounts over there. So it's 1, 2, 3, 0, 1, 2, 3, plus the 12,000 because they returned goods. And then I'm going to minus the floor. Minus what's on the floor, eh? And then I'm going to see if my answer is a positive or a negative. So my answer is a positive. If you get a positive answer here for book minus floor, you have a trading stock deficit. Okay? So we have a trading stock deficit because whatever is in the books is now more than what you count in the store. It means we have a shortage. So that means we have a deficit of 3,000 Rand. If you got a negative answer, then this would be a surplus. So under expenses, I don't see trading stock. So we have to fold this in, eh? So we call this trading stock deficit. My handwriting is big, so I'm going to write my notes here on top. Remember, it's what's in the book. So this was what's in the book, plus the data who returned, also in the book. Then what's on the floor? That was on the floor. And the answer was 3,000. And we said because it's a positive, it's a deficit. So we just put it there. So that's our trading stock deficit. Packaging material was counted. This packaging material, we always minus, eh? So I go and look for packaging material. I see packaging material over here. This packaging material. 3,700. So I'm going to write that in 3,700. And then the adjustment here will always be minus. So I'm here. So that 980 will be minus. And then I get that answer to be 2720. Okay, let's mark so far. For my trading stock deficit, I have 4 marks. 1, 2, 3, 4. For my packaging material, I have 2 marks. So 1, 2. For my depreciation that I added, I have a mark there and I have a mark there. Okay, so let's look at the next adjustment. Adjustment number 3 says a debtor, Z. Smith. So a debtor was declared insolvent. So a debtor was declared insolvent. Estate paid 55 cents in the rand. So okay, estate actually paid some of the money back. So 55 cents is 55%. And they paid 660. That's how much we received. And this was already recorded. Okay. But the balance, so the balance of an account must be written off. Okay. So let's figure out this one. So when a debtor is written off, we call this bad debt. So when a debtor is insolvent, there's 2 accounts involved, bad debt and debtors control. Bad debt is always a plus, né? And debtors control is a minus because the person will owe you less money since they're not going to pay you back. You will have more bad debt because people are not paying you. But now we need to figure out how much money are we writing off. So there's many ways to calculate the missing amount, eh? But what they are telling us, this person owed us an amount. So this person, Z. Smith, owed us an amount. Then estate, so the bank, paid us 55% of this amount. And that was equal to 660. But we want to know, what is this amount? What is the full amount that she owed us? I'm going to do some maths now. I'm going to keep the amount on this side. Then I'm going to say 660. Then when you times on the side by 55 over 100, you can times on the other side as well, but you switch the fraction around. Let's see if we can figure out what the full amount is. So what is the full amount? So I get the full amount to be 1,200. But this is not the part we're writing off. This is the full amount she owed us. Her estate paid out. That means the rest we must write off as bad debt. So I get this to be 540. So my bad debt is 540. So 540 in the income statement, and debtors control is in the balance sheet, but we're not doing this part of the balance sheet. So we don't have to show that 540. So this part is going to the income statement as a plus. So let's go to our income statement. So do you see grade 12? Here by the income statement, there's bad debts. So I'm going to go to bad debts and I'm just going to add the 540 that I just worked out. Close the bracket and I'm going to total. I get 14,640. Okay. And you get 1 mark for 540, 1 mark for 14,640. Okay, so that was that adjustment. Let's go to our next adjustment. Provision for bad debts. Provision for bad debts must be adjusted to 21,220. So what we are going to do here is we are going to say What is our provision for bad debt at the moment? So it must be here under the balance sheet section. Provision for bad debt, here it is. It's 22,000. So at the moment, provision for bad debt is 22,000. It must be adjusted to 21,220. So for provision, if it must be adjusted to, we find the difference between what's in the book minus what's in the adjustment. So if this answer is a positive, for provision for bad debt, it's an income. Okay? So the difference here is 780. That's the difference. So let's go back to the income statement. In the income statement, we said it's an income. I'm going to go to other operating income over here. So I'm going to go to other operating income over there, and I'm going to fill in here provision for bad debt. And this amount over here is 780. Okay? And that's the only thing I'm going to do to that adjustment over there. Nothing else for the balance sheet. Okay, let's look at the next adjustment. Adjustment number 5. Adjustment number 5 says the premises have been rented out for the past 5 years. Okay? So we've been renting out our premises. The rent for March 2024 has been received and recorded. But our financial year ends February, which means if it ends here by Feb, we received the rent for March. Okay, so we received 1 month in advance. Due to renovations, the rent was decreased by 25% per month for 3 months from April to June. This is March 2023, 1st of March. So from April, May, and then June. Oh, for those 3 months, the rent was decreased. So that was 25% less. So the point of the matter is we received the rent for 13 months. And remember, we should only receive rent for 12 months. So one of these months is income received in advance. So now we need to figure out how much is the rent. So the rent in the table in our balances here, and we look for rent income. This rent income here is for 13 months. The rent wasn't the same for all 13 months. For 3 months, the rent was lower. So there's 1 month here in front, and then from June to March. How many months is that? So you have the whole of July, August, September, October, November, December, and then Jan, Feb, and March. So it's 1, 2, 3, 4, 5, 6, 7, 8, 9, and March at the beginning. Yeah, that makes sense. It makes sense for this to be 10 months in total because this is 3 over here in the middle. So then 3 months is with the decrease and 10 months is without the decrease, because we received the rent for 13 months. One of them is income received in advance. It's this one over here. So I am going to take 1 month's rent and minus it from that amount because it's income received in advance. But now I need to figure out what's that amount. I'm going to set up an equation. I'm going to say for 10 months, the rent was just normal without an increase or a decrease. Then I'm going to say, so I'm going to call this 10x. Then I'm going to say plus 3 months. The rent was 25% less than the normal rent price because the rent was decreased. So I'm going to say 1 minus 25%. So 1 minus 25% is 0.75. So 3 times 0.75 is E, I get 2,25, eh? So that's what I'm going to do. That's how I got that, eh? So there's many ways to do it, but I'm going to do it like this. And this must give me 208, 250. So then I'm going to add this and this. It gives me 12,25, 208, 250. So then I'm going to say 208, 250. Then I'm going to divide both sides by 12 and I get x to be 17,000. So just remember, the 17,000 is the rent without the decrease. So this 1 month over here, that was income received in advance. So the two accounts involved is rent income. So it's rent income and it's income received in advance. So my rent income is going to be minus 17,000. So income received in advance is a minus in the income statement. Take it out because it doesn't belong to this financial year. It belongs to the next financial year. And then income received in advance can go to the balance sheet under liabilities. So let's go to our income statement and put these amounts in. Here under rent income, I'm going to take away 17,000 and I get that total to be 191,250. And then that's income received in advance. If I go to trade and other payables, I'm going to add here my income received in advance, because that falls under trade and other payables. I'm just going to fill in the balance sheet also as I'm going along. Let's go to the next adjustment. Adjustment number 6 says a debtor with a credit balance of 10,900 is to be transferred to the creditor's ledger. So we have to transfer this balance. So let's go to our note. So let's say you have a debtor. A debtor is a plus and a minus because it's an asset. So it says here that this debtor has a credit balance. On the credit side of the T account, we have 10,900. We are going to transfer this 10,900 to a creditor's ledger. A creditor's ledger or a creditor is a liability, so the sign is a minus and a plus. I'm going to cancel this amount. In the debtor's ledger, to cancel a minus, I must put it on the plus side. And then transfer this to the creditor's ledger. So it's on the plus side, so it must go here to the plus side. 10,900. When you transfer, you first cancel, opposite sign, and then you take it to the other account. Debtors control is, we're not busy with that account at the moment, but we are busy with creditors control in the balance sheet. So do you see this 10,900? It's a plus for creditors control. So when I go here to the equity and liability section of the balance sheet, do you see there? I'm going to go add, because it was a plus, I'm going to go add the 10,900. Okay, my handwriting is too big. So this adjustment basically had nothing to do with the income statement, only the balance sheet. Let's go to our next adjustment, number 7. This adjustment says the company has 3 directors and they all earn the same monthly fee. 2 of the directors have been employed since 2022 and a new director, so the last one, was appointed on the 1st of September 2023. So this is in our financial year. One director went overseas and was only paid up until 31 December 2023. Provide for outstanding directors' fees. It means we still owe directors' fees. So let's break this up. Okay, so we have 1, 2, 3 directors. The first 2 directors, they are employed for the whole year. So this one is also employed for the whole year. The last director, the third director, it says here a new director was appointed 1 September 2023. So this one was appointed over here 1 September 2023. Okay. And then this over here is 29 Feb. Okay, so the end of the financial year for all three is 29 Feb, and the beginning for all three is the 1st of March. Then it says one director went overseas and was only paid up until 31 December 2023. So one of the directors, eh? So let's choose the first one. The first one went overseas and was only paid until 31 December. So here by 31 December, this one was paid only up until there. So this director must still be paid for that part over there. Director number one was paid from the beginning till there because he went overseas. The second director was paid for the whole year. The third director was paid from the 1st of September to the end of the year because that director started late. So now I'm going to add these months, eh? So from the 1st, so let's look at director number one. From the 1st of March up until 31 December. Let's write that down. It's March, April, May, June, July, August, September, October, November, and the whole December. So this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So director number one was paid for 10 months. Director number two was paid for the whole year. So that's 12 months. Then director number three, let's work out. Director number three started on the 1st of September. So that gives me the whole of September, October, November, December, Jan, Feb, and March. No, not March. Jan, Jan, and Feb. Okay, how many months? 1, 2, 3, 4, 5, 6. So this one was paid for 6 months. So now we're going to work out. In total, how many payments did we make? We made 10 payments for director 1. We made 12 payments for director 2. We made 6 payments for director 3. And this gives me a total amount of payments. I get 28 payments. So that means when I go back to this table, do you see that this fee is over here, these fees over here? The fees there is for 28 payments. So I'm going to write down this amount was for 28 payments. So I'm going to divide that by 28 because I want to see how much is one payment. So now I'm just going to divide. So I'm going to say 1540123 divided by 28. I get this to be 55,000. So one director gets paid 55,000 per month. So this is the salary of one director per month. So do you remember we said that this over here must still be paid because that director went overseas. So that is for January and February. Because he was paid for 10 months, it means 2 months is still outstanding. If you get paid 55,000 per month, then 2 months is 55,000 times 2. And that gives me 110,000. So let's write down. Director's fees are still outstanding. 2 accounts involved. It's director's fees and accrued expense. Because I must still pay it. Anything accrued is a plus. So this is a plus 2 months salaries and accrued expense is 110,000. And this will go to the balance sheet under liabilities, trade and other payables. And this one will go to the income statement. So here by trade and other payables, I'm going to add the 110,000 accrued expense. And then here by the income statement, I'm going to go look for director's fees. Oh, there's director's fees. So here I'm going to add, I must still pay 110,000. And then I'm going to total my director's fees to be 1650,000. And if we mark this, according to the memo, you get 2 marks for this 110,000 and 1 mark there for that amount over there. Okay, grade 12, we're almost done with our adjustments. Let's look at the next adjustment. The loan statement was received from ZX Bank
on the 29th of February. So that's the end of the financial year. And then they give us the loan table. We have a loan statement. We have a balance at the beginning. We have repayments. That includes interest. Interest capitalized is a question mark. And then we have balance at the end. So here with the loan table, because we're busy with the income statement, I need my interest. So I need to work out the interest. To work out the interest, I have a little formula that I can use. So for my interest capitalized, to work out interest from a loan table, our formula is balance at the end of the loan table plus repayments minus balance at the beginning. This will give me the interest. Okay? So the balance at the beginning is for the financial year. The balance at the end is for the financial year. But do you see that the monthly repayments is per month? So the 75,000 is per month. I need that to be for the year because I can't put the repayments in here if it's for 1 month. So let's quickly work out these repayments. 75,000 per month for the whole year times it by 12. I get 900,000. Okay, so my total repayments for the year is 900,000. So let's work out our interest now. So I'm going to say balance at the end. So I'm there. So I'm going to say balance at the end, 1984,000 plus repayments for the year, which is that. And then minus balance at the beginning, which is 2509,000. And I get, okay, and I get 3. So then I get 375,000. So that is my interest capitalized. This will be the interest capitalized. That will go to the income statement. So let's put that in quick. So here by interest, we can write all our notes down. So we say this balance at the end, yes. So we can write 1984,000. Then plus the repayments, not for the month, for the year, that's 900,000. And then minus the balance at the beginning, which was that. So that's how I worked it out. And then I got the answer there to be 375,000. And then I must just remember interest expense is in a bracket. Okay? But then this loan table also affects the balance sheet. So let's go to the liability section. Do you see here it says mortgage loan over there? Is my balance at the end? So it's this balance at the end. So let's put that in. It's this balance at the end, 1984,000 minus this part that we're going to pay off in the next financial year. So repayments will remain the same for the next financial year. Our repayments were 75,000 per month. So that 75,000 times 12 gave us 900,000. But this included interest. So I'm going to take the 900,000 and minus the interest. This interest was capitalized. So if I minus that, I get 525,000. So my repayments actually 525,000. So then look here, this is now 525,000. The mortgage loan is the balance at the end minus the short-term portion, the portion you're paying off. So let's total this. I get 1,459,000. And then I must just remember this 525. That 525 goes under current liabilities as the current portion of the loan. So whatever you minus there must always go as the current portion of the loan under your current liabilities. Okay, and I think we've dealt with the loan now. So let's go to our last adjustment. So our last adjustment says 17,000 is still payable to SARS. Okay, so we still owe SARS 17,000. We're going to put this in two places. The 17,000 that we must still pay to SARS must go to the income statement. So the end of your income statement, there is an income tax. So that income tax consists of two amounts. It's this provisional payment that we made here. So we already made these payments, 150,000. So this 150,000 goes there, plus the part that we must still pay. So I get my SARS income tax to be 167,000, and this must also be in brackets. And because I still owe SARS, it's a liability, eh? So SARS income tax is then 17,000. Just to show that that's a liability. Let's finish our ordinary share capital note, and then we'll finish our balance sheet, eh? And then we'll total everything afterwards. So I'm going to use information D to do the ordinary share capital note. So let's go to information D. So here's information D. Authorized shares consist of 3 million shares. So that's indicated there. So that's fine. Then it says on the 1st of March, the beginning of the financial year, there were 1 million shares in issue. Okay, so we can see that that is indicated there. So that's done. We just don't know what this amount is over here. Okay, let's continue reading. It says on the 1st of November, during the financial year, the company repurchased 120 shares. Okay, that's also indicated here. There, at 7 Rand 20 each. This is the total price they paid. But that price doesn't go to note number 7. This was 20% above the average price. So the average price must go to this note. Let's work that out. We bought back the shares for 7 Rand 20. This was 20% above the average price. So to get to the average price, I'm going to say 720, and I'm going to divide that by 1 comma the percentage. So I'm going to say 7 Rand 20 divided by 1 comma 20%. Okay, and I get this to be 6 Rand. So 6 Rand is the average price, eh? So I bought back the shares for 6 Rand each. So I'm going to write here at 6 Rand, and then I'm going to say 120,000 times 6 Rand. So I'm going to multiply those two, and that gives me 720,000. But repurchase must be in brackets, okay? So that is the average price. That means this price here above is also 6 Rand. So then I'm going to say this times that 6 gives me this 6 million over here. Okay, so that's the same 6, eh? Let's read the information. 10% of shares on the 1st of March 2023. So 10% of the unissued shares. Now remember, you have 3 million shares authorized to be issued, but you only issued 1 million. So the amount of unissued shares is 2 million. So now it says 10% of these shares were issued at 6 Rand 60 per share. So 10% of 2 million, so I'm going to say 2 million times 10 over 100. And I get that to be 200,000. So 200,000 shares were issued. So these shares were issued, and they were issued at 6 Rand 60. Okay, so then this made us 1.3 million. Okay, so I just said, how did I get that? I said this times 6 Rand 60 gives me that. Okay, and then another way to work out the 6 million over here, let's say that 6 million you couldn't figure it out. What you can also do is you say this minus this plus this. Can you see I do the opposite when I start from the bottom? So when you start from the bottom, you say this. This is a positive, so then you say minus. This is in brackets, so then you say plus. And that will also give you the 6 million over there. So that's note number 7. And then the only thing left for us to do is this last part over here.
a final dividend of 22 cents. So a final dividend was declared at the end of the financial year, and it says all shareholders on the share register qualify. So that means, oh, I have a missing amount here. Let's put this amount in. Do you know how to get it? You say this minus this plus this gives me that. So let's fill that in. So I get that to be 1,080,000. Eh? So all these shares, so all these shareholders qualify for a final dividend. I'm going to take the number of shares and I times that by 22 cents, 22 over 100. And I get my final dividend to be 237,600. So my final dividend goes here as shareholders for dividends. And how did I work it out? I said 1,080,000 times 22 cents, 22 over 100. And that gave me 237,600. Okay, so I just had to do that last part. And I think we can now total our table. Let's total the equity and liability section. Trade and other payables over here. Let me add this. Trade and other payables will be this amount plus that 17,000 plus that and plus that. When I add up all the amounts, I get 912,190. To get my current liabilities, I'm going to add all these amounts up in this block. And when I add up those amounts, all those amounts, I get 1,691 and then I get 790. Okay. Then for my non-current liabilities, there's only one thing I must add up and it's the mortgage loan over here. I just rewrite that amount and I get 1,459,000. And then I have some missing amounts. So look here. Ordinary shareholders equity is this block over here. But now I don't have retained income. But when you look at the last information, why did they give us this information? Look there. Net asset value per share is 620 cents. If you go down to your formula page, let's go see what's net asset value per share. Net asset value per share is this formula over here. It's shareholders' equity divided by the number of shares issued. I'm going to write net asset value per share is shareholders' equity. So this is shareholders' equity over the number of shares in issue, times 100. Okay, that's the formula. So in AV, the net asset value, they gave you it's 620 cents, And this is shareholders' equity. We don't have shareholders' equity, but we have the number of shares in issue. It's this 108,80,000 like that. So we have that. I get it from this amount over there. And then I'm going to times it by 100. So now I'm going to see, can't I work out the shareholders' equity? So I'm going to say shareholders' equity is equal to the 620 that's on the left-hand side. Then, because I'm multiplying by 100, when I take it over, I divide this by 100. And because I'm dividing by this, I'm now going to times by this. Okay? And then I'm going to check. Now see what is the shareholders' equity. So on your calculator, you work out that. I get this answer to be 6,696,000. That's my shareholders' equity. So here where it says ordinary shareholders' equity, do you see it? That amount is now, let's write it in, 6,960,000. We know that this rate table, if I add up those two amounts, it must give me that amount. So now I'm going to say this amount minus this amount will give me retained income. So I'm going to minus those two, and I get my retained income to be 96,000. That is the balancing figure over there. Eh? So there, I think we're done with the equity and liability section. We're done with note 7. So let's go finish our income statement. So my sales, if I work out my sales, I get my sales to be 333,600. Okay. I get my cost of sales to be 277,500, but cost of sales must go in a bracket. And then my gross profit is this minus this. Gives me gross profit, eh? So my gross profit, I get to be 555,100. That's my gross profit. Then my other income. Other income is this whole block over here. So I add up all of those amounts, and that will give me other income. But other income is gray, so I don't have to work that out. I don't have to work out this. I don't have to work out that. It's all gray blocks. So there's all my expenses. We wrote all of that in. Looks about right. Everything else is gray, so we don't have to fill that in. It looks like we've completed everything in here. And then you can just look at the memo to see how you get marks. I think we completed the whole income statement and the notes. Okay, that was good. Well done.